Most people overpay for cars, and they don't even know it. Walking into a car dealership feels exciting, but it is actually a financial minefield designed to separate you from money. Salespeople are trained to manipulate your emotions, making you focus on the monthly payment rather than the total vehicle cost. Today, we are breaking down the 4 most common ways to buy a car and the hidden traps behind them. Understanding these methods is crucial because making the wrong choice could cost you thousands of dollars over the next few years. Let us start with the first and most traditional method, which is buying your vehicle outright with cold, hard cash. This is often considered the simplest way to buy because you own the car immediately with absolutely no interest payments. The psychological benefit is massive because you do not have a monthly bill hanging over your head for 5 years. However, the major downside is that you are sinking a large amount of capital into a rapidly depreciating asset. Cars are depreciating assets, meaning they lose value every single day, which is terrible for your long-term net worth. By paying cash, you also reduce your liquidity, leaving you with less emergency funds for other unexpected life events. Furthermore, buying with cash often limits your options to older or less reliable vehicles if your savings are currently modest. Now let us move to the second method, traditional financing, where you borrow money from a bank or the dealer. In this scenario, you make monthly payments covering the principal and interest until the loan is fully paid off. The danger here lies in the interest rates, which can significantly increase the total amount you pay for the car. Dealers often trick buyers by extending the loan term to 7 years just to lower the monthly payment amount. While the monthly payment looks affordable, you end up paying thousands more in interest over the life of the loan. You might find yourself still paying for a car that has started to break down and requires expensive repairs. This leads to being underwater on your loan, where you owe the bank more than the vehicle is actually worth. If you must finance, aim for the shortest term possible and secure a low interest rate from a credit union. Next up is leasing, which is essentially renting a car for a fixed period, usually 2 to 3 years. Leasing offers the lowest monthly payments because you are only paying for the depreciation of the car during that time. This method is attractive for those who always want to drive the latest model with the newest technology and safety. However, leasing comes with strict mileage restrictions, and exceeding them results in hefty penalty fees at the end of the term. You also have to worry about wear and tear, as dealers will charge you for any scratches or minor damages. The biggest drawback is that after years of making payments, you own absolutely nothing and must start the process again. It creates a cycle of perpetual payments where you are constantly renting your lifestyle without ever building any real asset value. Finally, we have the personal contract purchase, or PCP, which is a hybrid mix between financing and leasing a vehicle. With PCP, you pay for depreciation, and at the end, you can return the car, buy it, or exchange it. Dealerships love this model because it keeps customers trapped in their ecosystem, constantly upgrading to new cars every few years. The trap is the massive balloon payment at the end if you want to keep the car, which many cannot afford. Most people cannot pay the lump sum, so they are forced to roll over into a new contract, never owning anything. Each of these 4 methods has specific use cases, but they all involve spending money on a depreciating liability. Now, this is the most important part of the video where we discuss the hidden concept known as opportunity cost. If you spend $30,000 cash on a car, you lose the opportunity to invest that money elsewhere. The stock market historically returns about 7% per year, meaning your cash could have grown significantly if invested properly. In 5 years, that car will be worth half its value, while your investment portfolio could have increased by huge margins. Sometimes, it is smarter to take a low-interest loan and keep your cash invested where it earns higher returns. Of course, this strategy carries risk, as markets fluctuate, but over the long term, the math usually favors the investor. True wealth is not about driving the most expensive car, but about making your money work efficiently for your future. Don't fall into the trap of looking rich while being poor. Focus on building assets rather than collecting expensive liabilities. The smartest move is often buying a reliable used car that is 3 years old, letting the first owner pay depreciation. At 3 years old, a car is still modern and reliable, but it has already lost the biggest chunk of value. You get a great vehicle for a fraction of the price saving thousands that can be directed towards your investments. Remember, every dollar you spend on a car is a dollar that cannot grow for your retirement or financial freedom. Make your car purchase a calculated financial decision, not an emotional one driven by slick marketing and shiny showrooms. We want to know which method you prefer. Do you buy cash, finance, or lease? Let us know in the comments. If you found value in this breakdown, please smash that like button and subscribe to stay ahead in the money game. Check out our other videos for more insights on how to manage your finances and build lasting wealth for yourself. Thank you for watching Wise Money Moves. Stay smart, invest wisely, and we will see you in the next video.